We're focusing on Apple. So amid reports that the Justice Department may investigate the iPhone maker's antitrust behavior, CEO Tim Cook fired back, telling CBS News earlier this week that Apple is not in a dominant position.
With size, I think scrutiny is fair. I think we should be scrutinized. I don't think anybody reasonable is going to come to the conclusion that Apple's a monopoly. Our share is much more modest. We don't have a dominant position in any market.
Joining us by phone is Mark Mahaney, capital markets analyst at RBC. And Mark, we just heard what Tim Cook was saying from Apple, but Apple's not the only tech giant here that's under fire. We have Google, Amazon, and Facebook also caught up in the crosshairs. How big of a threat do you think regulation is to some of these tech giants?
Oh, I think it's a material risk for these names. I think it's already played out in a couple of different ways. Google now is paying $2 to $3 billion a year in fines to the European Union. We're going to have a $3 to $5 billion fine somewhere in that neighborhood for Facebook, paying to the FTC in the U.S. That'll be its single largest fine. And I think there's a possibility, distinct possibility, that the EU or the European Commission will attempt to fine Amazon for some of its practices in this third-party marketplace. There's clearly fine risk with all of these names. I don't think there's revenue risk. I think breakup risk is also extremely low, especially for Amazon. But Facebook and Google are clearly, because the question had to do with dominance. Well, here are two companies with dominant market shares. Google accounts for the vast majority of search revenue worldwide. And Facebook accounts for the vast majority of social media revenue worldwide. So depending on how you want to cut the market, you can clearly say that these are two dominant companies.
Mark, I know you're saying that the breakup risk is low right now, but if one of these companies were to be forced to be broken up, which company do you think is best positioned to handle that?
Well, let's see. Let me try to answer the question two ways. One, the company that I think would be most likely to have a forced divestiture, how about that? I think that would be Google, and I would think they would be forced to divest their DoubleClick ad tech network, their DoubleClick advertising network. I think the company that would be hardest to see why you would force a divestiture would be Amazon. And, clearly their share of retail is lower than Walmart's. If you're going to bust up Amazon, you better start off with Walmart, and I don't see people looking to do that. I also think, frankly, at the end of the day, think that as my understanding in the U.S., that this should be based on harm to consumers, and I don't think you're going to find too many consumers that are complaining about Amazon, Facebook, or Google. Now, they may be complaining about Facebook for privacy reasons, but I also think that's a very small percentage of actual users. I think what these companies have done has been unmitigatingly good, positive for consumers, and so there may be a lot of Sturm und Drang now, or whatever the expression is. There may be a lot of concern over these assets, but I think for most consumers' minds, there's little need for that. There's competitive risk that there's competition in some cases has been snuffed out, but I think you would find that with most large platforms too.
So, Mark, it sounds like you're still pretty positive on all of these big tech giants. Is it fair to say that there's still upside potential, even though we have so much uncertainty when it comes to regulation in this space?
I guess the way I think about it, and now we're talking about picking stocks, is I think regulation probably limits the multiple. It limits the PE. It doesn't impact the E, so the earnings, but it does impact the PE, the multiple that people would be willing to spend. And here's the way I'd think about it with a name like Facebook. Prior to Cambridge Gate, a year ago, this company was carrying a PE multiple of 25 times. I think because of this kind of regulatory overhang, that peak multiple now may be, call it 22, 23 times. I don't think there's real science behind that. That's more of an art call, but I think there is I don't think they get as high of a multiple just because there's always existential risk uncertainty, and I think you can still, given where the stocks are now, I think you can still make money being long them. And I think, by the way, that the antitrust risk against Facebook, I think that's a real stretch, and like I do with Amazon too. So our favorite names here of the large tech platforms, we would like Facebook, and then another one that we haven't talked about yet is Netflix, in part because one of the reasons we like it is got the least regulatory risk. It's probably the only one that can say, actually, our competitive space is about to get a lot tougher in the next 12 months. So I think they're far from seeing any regulatory risk there. And we also just like the name fundamentally.
Yeah, Mark, let's talk more about Netflix. I mean, what do you think is the biggest risk to their business? Is it the competitors that are planning to enter the space over the next 6 to 12 months?
I think that's what the financial markets perceive as the biggest risk to Netflix. Launches from Disney Plus, launches from whatever Apple calls its streaming service. Maybe that's going to be called Apple Plus. Launches from Comcast and AT&T Time Warner. I just think the value proposition and the original content that Netflix has, both of those, I think that makes that competitive risk much smaller than the financial markets realize, and that's why it's an interesting asset right here and right now. You also have a very powerful content slate in the second half of this year, beginning on July 4th with season 3 of Stranger Things, and you'll have a price increase that we think is successfully rolling through, which allows revenue growth to accelerate, margins to expand. Usually stocks work well when you get that combination. So we like Netflix. We think this is a business with roughly 150 million paid subs today. I think we're going to see this go to 500 million paid subs over the next 10 years, and I think this is a business that is currently losing, generating free cash flow losses that can, in the next 5 years, start turning the corner and generate substantial amounts of positive free cash flow. So I think there's some things that can really turn its way. That's why we like the stock.
All right, Mark Mahaney of RBC, we'll leave it there. Thanks so much for joining me today.